Starting. All attendees are in listen-only mode.
Thank you for joining us today for the last webinar series. My name is Corinne Carey and I'm the Pension and Benefits Officer with the NSG EU. I'll be moderating today's webinar. Today's session will be discussing the capital stewardship and examining the growing role of social, environmental, and governance factor in pension plan investment. Before I introduce today's speakers, I have a few housekeeping items. You should be able to both hear me and see the PowerPoint presentations during the webinar. If you need assistance with your connection, please dial 1-855-352-9002. Press 1 at each of the 4 menu options, then press 0 to reach a customer service agent who will be able to help you connect. After the presentation, we will be opening the floor to questions for the presenters. Questions can be submitted by typing your question in the question area in the control panel in front of you. At the end of the session, I will read any questions that have been submitted for our presenters to answer. If, for any reason, we cannot answer your question during the session or we run out of time, please contact info@share.ca and we will make sure your questions get answered. We have scheduled 1 hour for this webinar. Our first speaker today is Kevin Thomas. Kevin is the Director of Shareholder Engagement at the Shareholder Association for Research and Education, which engages companies on behalf of Canadian investors with more than $15 billion in assets under management on environmental, social, and governance issues. Prior to joining SHARE, Kevin worked internationally with companies, governments, and trade unions to improve wages and working conditions in global supply chains and as a political advisor and chief negotiator for First Nations in Alberta. So I'll turn things over to Kevin.
Great, thank you. I'm just going to get my screen up here. Hopefully you'll be able to see that. Now, I'll tell you a little bit about SHARE first of all. I assume you probably know something about us just in the course of doing these webinars, but I'll do a bit of a quick overview of who we are and what it is that we do. And then I'm going to talk a little bit about the idea of capital stewardship and responsible investment with a particular focus on things like shareholder engagement and proxy voting, which of course is one of the big things that SHARE does for its clients. Now, a quick overview of SHARE. We were formed in 2000, so 15, 16 years ago, by the BC Labour Movement. And since that time, we've expanded from that to include investors from as members from foundations, pension funds, mutual funds, religious investors, university endowments, etc. And most of these clients are small and mid-sized funds. So the idea we have really is that it's a model of collective action. That is, that you don't, just like you wouldn't bargain individually, but collectively, we also believe that collectively these small and mid-sized funds actually have power. So we currently represent funds in total with assets under management of about $15 billion. We have offices in Toronto and Vancouver and a staff of 12. And our staff are, you'll be pleased to know, are unionized with the United Steelworkers. Actually, I think we're the only unionized proxy voting service in Canada, if not North America, and certainly one of the few non-profit organizations doing this kind of work. And it's an important part of our model. Now, our primary work, it centers in 3 areas. One, which you're seeing now, is trustee education. We run pension trustee courses to prepare people for board seats and to upgrade the skills and the understanding of current trustees. We also work on public policy related to both capital markets, that is, how the financial markets work for investors and for society in general, and more general business law, which is primarily focused on, I guess, on changes that would make both of those, capital markets and businesses themselves, more sustainable and encourage corporate accountability. And last but most definitely not least, we provide what we call responsible investment services. And that's what I'm going to talk about really today. And by this I mean a number of services such as proxy voting for funds that hold shares in public companies, or shareholder engagement, research on issues which are of concern, both environmental, social, or governance issues for that matter, and policy development. And the vision that drives this work broadly is quite simple. We have this idea that really trustees should be equipped to oversee the investments of the funds that they hold. That's first and foremost, have the tools and the knowledge to be able to do this in a strong and sustainable way. And then the financial markets that we operate in have to be changed. I mean, really have to be driven towards more sustainable investment options and make sustainable investment a viable option in financial markets. And lastly, of course, the idea that funds as a whole act as what we say as stewards of their investments. They don't see them as a short-term, make a quick buck kind of thing, but they've got a long-term investment. This is especially true for pension trustees. They have a long-term investment, and they need to act as owners of those investments if they want to see those prosper over the long term. And so we have I guess also what I'd say is a vision around the idea of shareholders, companies, and responsible investment. And again, it's really a very common sense kind of vision. But as they say, common sense is the least common of the senses. So I'm going to put it up here anyway. The first of these three principles is really that corporate management is best when it's accountable. That is, you can't trust them just to do what they think is good for their own selves. You have to hold them accountable for the other stakeholders that are affected by this business. The second point, which again I think flows from that, is that real shareholder value, that is rather than just making a quick buck, real shareholder value is not built by wasting and polluting resources, by undermining the employees, or by antagonizing the communities you operate in. Long-term value is done by exactly the opposite, by valuing stakeholders, by valuing the environment, and by building a company that respects those principles. And I guess lastly, and again, this should be obvious to pension trustees, the long term matters. We have what some people have dubbed as quarterly capitalism happening now, very, very short term outlooks. And that's killing us. It's a terrible outlook for the markets, it's a terrible outlook for companies, and it's certainly a terrible outlook for society and for the environment. The reality actually is, of course, there are a lot of real risks to shareholder value because of that disrespect for those basic principles. And those risks to shareholder value are therefore a risk to the value of a pension fund's portfolio. And the problem with many of these, what we call environmental, social, and governance risks, is that they tend to be ignored by mainstream investment analysis. I mean, mainstream analysis, the standard that we see is notoriously short-term and really kind of myopic, I guess. The focus is on financial metrics and too often on a quarterly return basis, rather than thinking about the factors that make a business successful over the long term. And of course, for pension trustees, again, their very nature is to have a long-term outlook. So there's a real mismatch between how the mainstream managers handle investments and the conception of portfolio value over a long term. So I guess what I'm getting at is that responsible investment is about taking into account a broader set of factors that can influence the value of your investments. And these are primarily environmental, social, and governance factors. And I put one up here on the screen here just to start with something simple, to give an example of what we're talking about. Now, this is a really obvious one: health and safety and environmental issues. It's a picture from the Deepwater Horizon blowout back in 2010 with BP oil in the Gulf of Mexico. And this disaster, when that well blew, it pumped 4.9 billion barrels of oil into the Gulf, and it killed 11 workers. Just looking, that's the real cost of that disaster. But just looking at the company itself, in terms of cost to the company from that disaster, BP had to suspend its dividend. It announced plans to sell, I think, $30 billion in assets, and it had to set up a $20 billion fund to compensate the victims of the oil spill. $20 billion, that's not a small thing for that company. And so what this tells you is that these social risks or environmental risks aren't just something which are kind of an add-on, the sort of thing which a company puts in its annual report. Look how many trees we planted this year, or look, here's some happy kids that we gave some money to their charity. It's not about that. It's actually about real risks to the investment, that if you don't take into account these risks, you actually could face real material problems. And the reason I raised BP is because this disaster actually wasn't the first one that they faced. In fact, the commission that looked into this whole disaster went through a whole string of of previous disasters, previous instances, and came up with the idea that there was a systemic lapses and a series of cost-cutting decisions made by the company which really came at the expense of well safety. So if you're not paying attention to these things, you run the risk of these kinds of big disasters. I'm going to also speak to climate risk because I think it's one which is so critical to, we're hearing a lot about it as to how critical this is to long-term investment, to our society as a whole, and long-term investment. And here I guess we have to think about what effects does climate change have on our portfolios and what effects do our portfolios have on climate change. And I think the latter question has been a lot easier for people to focus on. They've asked, are we invested in oil and gas companies? What does that mean? What is the carbon footprint of our portfolio, as in how many are the companies in our portfolio emitting a lot of greenhouse gases, and could that change? But of course, we also need to think about what are the, just first and foremost, what are the risks to the pension portfolio from something like climate change. And so there are three real types of risks which help to show how we think about environmental, social, and governance risks in general. The first is the most obvious one. It's real, like, physical risks to the assets, and that is like floods, droughts, severe storms, these kinds of things that can add can directly damage physical assets or drive up your insurance costs. And sometimes they can be really obvious, but sometimes they're actually fairly hidden. For example, just a couple months ago, one of our analysts just released a report looking at the effects of flooding and drought on cotton production and how that actually directly translated into lost profits at apparel companies. So there's kind of knock-on effect from things, the effects of climate change. What's probably less understood and probably more disruptive in the longer term is the way that portfolios can be harmed indirectly through a general weaker economic growth and lower returns across the board. So not just each company by company, but across the board. But the one I really want to talk about quickly here is stranded assets. This is the idea. Well, we know that there's a disconnect between the commitments that were made in Paris last December at the COP21 meeting, with all the countries agreed on to keep global warming to 1.5 or 2 degrees at maximum. There's a disconnect between that and the amount of fossil fuel, that is oil, gas, or coal reserves already discovered. And that is, if we want to meet those targets set in Paris, a pretty large chunk of the known reserves, like the existing reserves, can't be burned. I mean, they're on the books of companies as assets, but if we're serious about keeping to that limit, all those companies can't burn all those assets. A rough estimate is actually the world's fossil fuel companies hold at least 3 times more proven reserves of oil, gas, and coal than can be burned if we're going to achieve that goal. So stranded assets, as a definition, are really fossil fuel resources that at some time prior to the end of their economic life are not going to be able to earn an economic return. And the thing is, I guess when I think about this, you have to put that against your cynicism about how likely it is the governments are really going to achieve those targets, because we've had lots of targets before. And so I tend to be an optimist by nature, but I accept that we may be cynical about the ability of governments to really crack down on this. But the thing is actually that there's a lot of ways assets get stranded. And so the most likely one, or the ones talked about mostly, is carbon pricing or regulations that make that happen. That if governments are serious about this and they get it done. But there's actually other ways that assets get stranded that are probably even more likely. And first and foremost are new technologies and new players making renewable sources more viable. And we're already seeing this, for example, in better battery storage and a massive drop in the cost of solar power in the last few years, photovoltaic power. And in fact, in 2015, that was the first year we saw more money being invested in renewables than in fossil fuels. And so what that does, as those become cheaper as options and more available and easier to install, they become the biggest drivers of declining demand for oil and gas and coal. So things get stranded not just because governments act, but because alternatives come into place, and therefore those assets are no longer valuable. So those are just two examples, health and safety and climate risk. The range of issues that can affect value for investors varies depending on the types of asset, the sector, the geography, time horizon, all that. But what we're sure about, I mean, not every issue is every environmental social issue is an issue for a particular company and a particular investment. But what we do know for sure is that analysis that's purely based on share price and maybe forward earnings is just not good enough. So the good news is that this is all becoming more and more accepted by large institutional investors. I think the idea of responsible investment is growing. There's an acceptance, really, a growing acceptance that these kinds of things can be material to a company's success and therefore to your fund's success as a pension trustee, for example. There's an acceptance that there are systemic risks, and capital markets, the way they behave in general, can also have an impact on your investment outcomes, and therefore we have to pay attention to those. There's acceptance that, as especially in the pension world, you have beneficiaries that are dependent upon this, that those interests aren't being well served if you solely look at the traditional investment analysis that ignores environmental, social, or governance risks. And frankly, there's society's expectations are changing. I think there's if you see, especially in the surveys of millennials, that there is a really strong expectation that companies have to be good corporate citizens in some form, and also that even other institutions like pension funds have got to demonstrate their good citizenship practices as well. So this is the image of what used to be considered an ethical investor, or someone who raised environmental social concerns with companies. And really it was this idea, you have this, it's all about mission-driven stuff, or impact investing, or really just about screening out all those bad actors out of the portfolio, and all you're going to really be allowed to invest in the end is some kind of, I don't know, like organic soybean farm, and therefore you're going to have low returns, like you were going to lose money, so you could not do this. This was the whole image of a responsible investor back in, say, the 80s and the early 90s. That's changed. I think the image of a responsible investor now is a bit different. It's probably a bit more like this. Well, actually, I don't know. I mean, maybe Mark Carney looked like that when he was a kid too. I don't know. But in any event, the idea of responsible investments now being discussed by not just by the fringe, but by central bankers like Mark Carney. He was previously the head of Bank of Canada, now of course Bank of England. Most major pension plans like Canada Pension Plan, the Ontario Teachers, they all have their own responsible investment mandates and staff. When you go to a meeting of investors on these issues now, there aren't any Birkenstocks in the room. It's really become something which is embedded in the mainstream, and more so. And it means that there's growing recognition that ESG, environmental, social, and governance issues, are material to investment outcomes, pure and simple. Give you a sense of the scale of this, there's something called the Principles for Responsible Investment, which was set up by the United Nations a number of years ago, I guess 10 years ago now. And this organization has, actually I think this slide's out of date, I think they have now about $60 trillion in assets under management represented at their table. That is, all of these institutional investors have signed on to these principles, and they represent a massive amount of money globally. That includes many Canadian signatories, both large and small. Share, of course, is a member of it as well. So let's dig a bit deeper. In the time I got left, I'm just going to quickly dig into what responsible investment actually looks like. On the sides of the screen here, there's two real main approaches to responsible investment. One is when you're trying to decide what goes in the portfolio. It's asset selection. And here's where you'll see some of that stuff where you screen assets. That is, either negative screens, you keep out companies or sectors that you think are not good investments for you for some particular reason. And a good example would be not investing in cluster munitions, or some don't invest in nuclear power if they have an issue with that, or tobacco. The other side of that is to integrate ESG stuff in your decision making. So here's where you may say we have two possible investments in a couple of companies, I don't know, real estate companies, and one of them has a better record environmentally than the other. And our investment thesis is that the buildings that have better environmental practices are better investments over the long term because their costs are lower, things like that. So we integrate that into the decision and choose the investment we think is better. And impact investment is really more about saying, say we want to invest in social housing because we want that outcome as well as the return. So that's a possibility. On the active ownership side, this is really where share has much more of a role. We look at what happens once you actually own the asset, and that's the key. If you've chosen what you want to invest in, now how do you act as an active owner? I'm going to talk about two of these: proxy voting and engagement. Proxy voting is really kind of the baseline of being an active owner. When you own a share in a publicly traded company, attached to that is the right to vote on a number of things. You vote to elect the board, you vote to appoint the auditors, you vote on some special things like mergers and acquisitions, and you can also vote on things like shareholder resolutions that are filed by shareholders but are voted on at annual general meetings. And a great example of that was just yesterday. Just yesterday, Share was at the meeting of Tim Hortons. You may have heard about this, raising the question of board diversity. And unfortunately, because the Tim Hortons is a controlled company, the vote went against us, but the company certainly heard loud and clear that this is a concern not only for the public but for shareholders. And a lot of these votes these days do turn on a small margin. This year, the say on pay vote, that is voting on executive compensation at Canadian Pacific, they lost that vote by 0.1%, but they lost that vote. That's an important thing. So this is an important right and responsibility of people who own or investors that own shares in public companies. The second one is shareholder engagement, and this is, again, as an investor, you do have a right to speak to management and to the board about how your company, the company you are invested in, is doing. And if you think that some of these risks around environmental or social issues can be material to the company, it's a responsibility to raise that with the company and ask them to do better. The thing is, we always think about shareholder engagement in sort of very activist sense, that this is something that's, if you're interfering with the company somehow, or that if you don't do it, there's kind of a neutral thing, the company just goes along as usual. The fact is that shareholder engagement is a regular thing for all sorts of shareholders. Unfortunately, many of those are what we call activist investors that are trying to squeeze quick short-term returns out of companies like hedge funds. And the message they're sending to the boards and management is not necessarily the same one responsible investors want to send. So there's a need for us to be in there at the boardroom speaking about why things like climate change should be addressed by a company, why we think that clean water and making sure that water use, polluting water sources is important for that company, why respecting human rights in your overseas supply chains is important so that you avoid all sorts of disasters or ongoing creating all sorts of problems in the communities you're operating in. Why dealing with First Nations rights and being responsible in your relationships with First Nations communities is critical to getting your projects up and running. A great example of that may be NUPGE and the Northern Gateway Pipeline, which how many years has that been on the books? It certainly is not up and running now, and the main reason it's not up and running is because of opposition by First Nations communities and the poor job that NUPGE did in dealing with those communities. So I'm thinking about time here. I wanted to speak to some quick challenges. First question, does it breach our fiduciary duty to talk about these supposedly non-financial issues? All right, will our rate of return be affected? And is this going to be a lot of extra work? Which is a fair question. Fiduciary duty, I speak quickly to that. Pension trustees have a duty. You've probably talked about this already on some of these webinars, but you have a duty to the beneficiaries, and that means that you do have to manage the fund responsibly. The key point here is that ESG factors can be, not only they can be material to the success of those investments and therefore should be considered, but they can also be used as a deciding point to tip the scales for something, like I said earlier, like a real estate investment, choosing the one you think might actually do better as a result of their attention to these kinds of questions. Rate of return follows closely on that. If we invest in some of these things, are we going to lose, or don't invest in some of these things, are we going to lose money? And the data is out now. It's very clear that these consideration of ESG factors is not something that harms returns over time. In fact, in many funds that have focused on this, they do better than the average benchmark. And some strategies, which, as I talked about, voting or engagement, actually don't have anything to do with foregoing investments in companies. They may actually have you invest in companies that have lots of room to improve, but you're in there actively improving those companies. So it's a positive role to play, but doesn't affect your returns. Or if it does, it may be in a positive direction. And lastly, I think it's a good place to end. Is this going to be a lot of extra work? I mean, great question. It can only be as much work as you create for it. I think the best thing is always to start with educating yourselves, and obviously you're already doing that, working on that, taking it one step at a time. There are service providers, Share being one, but there are others which help to walk through this, create policies to help you get the right information in front of your board, and to help with services like proxy voting and engagement. And of course, the best thing, as I said at the start, is to work collectively, learn from other like-minded investors and trustees, and take opportunities to participate in things like this where you can learn from experience that others have. So I think I'm going to leave it at that, and we'll come back with questions later on. Thanks very much.
Thank you, Kevin. I'm now going to introduce our second speaker, Mike Grimaldi. In September of 2012, Mike was appointed by OPSU to the OP Trust Board of Trustees. Mike brings 30 years of experience working in the Ontario Public Service and at OPSU. Retired in 2013, Mike previously worked at the Ministry of Labour and as a work advisor representing injured employees who were not unionized. He also served as an executive assistant to OPSU's former president, Leah Castleman. He is politically active and a strong advocate for defined benefit and jointly sponsored pension plans. In the fall of 2012, Mike was involved in negotiating the agreement between OPSU and the Government of Ontario that established a 5-year funding framework for the plan and exempted OP Trust from the province's proposed asset pooling for broader public service pension plans. He was elected to OPSU's executive board in 2003 and served as the regional vice president for Region 2, which is OPSU's second largest region, representing 26,000 members. So I'll now turn things over to Mike.
Thanks. I hope my slides are up now, and I'm going to start with strengthening the Canadian economy. The first couple slides are pretty generic, and because of the time constraints, I'm going to try and go through them quickly. So I think that most of you understand this slide. It's basically talking about how because of our retirement income system, and if there's financial security with retirees, they're able to continue their lifestyle. And that means spending, paying their taxes, which of course it ends up in being an employment multiplier. And in many communities, at least in Ontario, it's the retirement communities that are actually funding any kind of growth within the communities because of the hit to the economy. Here it talks about the assets, the amount of assets that have now come under pensions in Canada. And as most of you will know, the assets that most of our plans have are driven mostly by investment returns. And because of that, we can invest in other activities that grow the economy. And you'll note here that pensions across Canada have probably around 11,000 professionals in employment, and there's approximately 600 billion in assets across Canada. I can tell you the Canadian brand is known globally because Larry and I have kind of been doing a Laurel and Hardy kind of routine, and we were in Amsterdam earlier this week, and a number of people there had discussions with us afterwards, both on the bad side of Canada's pension plans, talking mostly about teachers and CPPIB and the kind of investments they do, and then talking about the good side of Canada pension plans across where we have jointly sponsored defined benefit plans who invest in a socially responsible way, which is very important to communities around the world. You know, how do they strengthen our movement? Well, as people will know, you know, we formed unions in order to protect our members from arbitrary use of management power. But we also fought to protect our members through pension funds. And the reason we did that is because pension funds have considerable financial power, and that financial power in many cases was being used against us. I remember a case with Borealis where they were involved in a privatization of a sector, and it was the members of their plan that were being laid off through this privatization, and so they were enabling a company to help privatize jobs that were actually laying members off who were paying into the plan. It's counterintuitive, and of course we needed to take control of our plan so that kind of stuff didn't happen. And then many people who have been on plans as trustees for a while will remember originally we were getting pushback from the employers saying, look, because of your fiduciary responsibilities, you can't look out for labor rights. And it was up to us to fight back and make people understand that part of our fiduciary responsibilities were things that Kevin just talked about, and amongst them were labor rights. You know, you're not being a strong fiduciary if you're laying off your members who are paying into the plan, and if you're not providing retirement security to the people who are your members of the plan. We have at OP Trust a statement of responsible investing principles that's very strong and takes into the wide range of things that Kevin talked about: the environment, climate change, human rights, social responsibility from workers' rights. All of those things are in our SRIP, and our SRIP is transparent. All the members can see it. In fact, we post it on our website. How did we get into this originally? Well, as I said, we didn't want our pension money to be used to impact other people's lifestyles and other people's work. At one point in time, our infrastructure group came to us about investing in a toll highway in Australia, and the labor trustees said, well, no, we don't want you to do this, and there was a real split on the board. And out of that, our labor trustees were able to negotiate strong guidelines in our statement of responsible investing principles. But I think more importantly is that it was the first time where we had that kind of in with our investment group, and part of what we were able to do over a period of time is build a culture in our investment group so that they now, when they're going out and looking at investments, don't have to come to the board and say, is this socially responsible or not? They actually want to invest in a socially responsible way. And so now it's built into the culture of those investment professionals. You should also know that at the beginning of OP Trust, it was set up in a very siloed way. So we had an administrative section headed by a chief administrative officer, and the investment function was headed by a chief investment officer, and never the twain shall meet. So there was kind of two separate silos, and we didn't have a CEO. So all of those decisions, for example, around investing and stuff, came to the board. We were a very operational board. We had our hands on all the decisions. As you can well appreciate, we're not all investment professionals that sit on the board. In fact, we're 5 union appointed, 5 government appointed, and those were difficult decisions without having some framework in order to make these decisions. More recently, probably 5 or 6 years ago, we determined to change that model and have a CEO, but put in these strict guidelines so that investment decisions didn't have to come to the board, but that we built a culture and an understanding within our whole plan that everybody was working in the same direction. Part of that process has evolved over time, so that the only time, for example, socially responsible investment decisions have to come to the board is when there's some difficulty or some problem, which happens rarely. On the other hand, where socially responsible investment has become a big benefit, for example, when we were at the Share Conference in Vancouver not long ago, one of the unions came to us with a problem they were having with a company in the United States where they were having labor relations issues, and they couldn't even get a meeting with the parent company. And we had some influence because we had some shares in that company. And when they spoke to us, we did an investigation, and what we were able to do is set up a meeting between the union and the corporate executive in order to work through the problems, and they worked through the problems, and the union later came back and thanked us. So those are the kinds of interventions we can do by being a socially responsible plan. And from a fiduciary standpoint, it was a good thing because it prevented them from having a strike or worse, and they you know, that was the way that they were able to work the problems out. So the way we work our socially responsible investment now is to monitor the way our investments are being done. We get regular reports. We have a socially responsible I guess section that actually reviews all the investments, works with our investment team, and they report back to the board regularly to make sure that we're following all the guidelines that we've put in place. I've talked about the SRIP. We were one of the first plans in Ontario to sign on to the UNPRI, and not only sign on to it, but actually live up to it. One of the things that I found interesting in the conference in Amsterdam was that the OECD guidelines, which are very good guidelines, and talking to some of the plans there, you know, they were saying, you know, if people follow these guidelines, you know, they would all be within the context of a strong SRIP, but they're guidelines. And when we kind of pushed them on, well, are they enforceable? There's actually a panel that you can go for mediation, and they can tell you the company was naughty, but there's really no penalty or, in my view, enforceable guidelines. So again, they rely on the plans to act in a responsible manner. So it's important, no matter where we are and no matter what guidelines we have, that we make sure that our plans are behaving in a manner that is socially responsible. The other thing is, if we're not making the decisions, it gives us more time to monitor, to make sure that our policies are being lived up to internally, and any breaches of our SRIP have to go directly to our CEO, who then brings it to us, and we can work on how to fix it and make sure it doesn't happen again. You can tell in the slides that it says here that we're not seeking perfection in every investment. Well, that's not true. We are seeking perfection in every investment, but we may not get there. Part of this, and we don't really have a slide on it, but part of this has got us to change our investment strategy. And the way we changed the investment strategy is from asset-based investing to what we're calling member-driven investing. And what that means is the way our investment professionals were paid would depend on how their asset class did. So for example, if you were in real estate and your benchmark was 10% and you made a 15% return, you know, you got significant bonuses out of that. The problem with that is, well, two things. One is many times high return means high risk. And since our approach to investing And that's why socially responsible investment is so important. It should be long-term. And the importance of investing is to keep our plan fully funded, not to make huge bonuses, and not to get into the casino mentality of investing. So when we went to member-driven investment, we made, as part of the bonus structure of our investment professionals, the funding status of the plan. So if the plan is fully funded, you get one kind of bonus, and if it's not fully funded, you get a different kind of bonus. What that enabled our professionals to do is there's now more interaction between the classes. Because, for example, if I'm in the real estate asset class and somebody else is in the private equity asset class, and if they're not doing well, it's going to impact on how I do as well. So there's more conversations inter-asset class. So, for example, if there's a good real estate deal, but maybe our private equity group should be involved in it, they can have those conversations and move forward. That makes, number one, that makes it better for the funding of the agency, and it's better to ensure the ongoing status as far as being able to supply the pension promise to our members, which is really what our raison d'etre is, our reason to be. So so that was one thing. The other thing it did is, for example, at our private equity group, we might have said your benchmark was 20%, which again was forcing them into more high risk investments. So they might look at a really good long-term investment that was going to pay 10% a year, which would be great for the pension fund, but it wasn't great for them. So they would pass that by and look for a higher return. So now they're looking at those kinds of investments because it's good for the fund. It's not what's good for the asset class. So those are things that have developed out of it, and it fits right in with our socially responsible investment principles, because when they're taking all of these into consideration, that's part of the risk. And if you take that as a risk management tool, it works out from a fiduciary standpoint. It's good for the plan, and it's good for our investments. So we've gone in a new direction on investments. We've gone, we strengthened our SRIP approach, and we're moving forward with that. So right now, from a trustee's standpoint, we're pretty happy with the direction of our plan, and I know that that way we don't get a bad reputation in the rest of the world. So that's the end of my presentation for today.
Thank you, Mike, for your presentation. Our final speaker today is Larry Brown. Larry has been the Secretary-Treasurer of NUPGE for almost 30 years. He became interested in social issues while at the University of Saskatchewan, where he served as the President of the Saskatchewan Federation of Students. Later becoming Executive Assistant to the Deputy Minister of Labour, the Chief Staff Officer with the Saskatchewan Federation of Labour, and then the Chief Executive Officer of Saskatchewan's largest union, the Saskatchewan Government Employees Association. In 1986, he was elected to his current position, where he serves as the CFO and one of the spokespersons for the National Union. Turn things over to Larry now.
Well, thank you very much for that introduction, and it's been a pleasure to listen to the other presentations, so this has been a really interesting session. This actually brings us to the close of this series of webinars. There's been a number of them over the weeks, and I know some of the people on the line have been a part of all of that. This has been a new process for us, and it's been very successful. I'm really pleased with the way it's gone. And I just want to register once more how indebted we are to Cher and to Peter Chapman and Nora Murphy and all the folks at Cher for working with us to take this kind of idea that we had and make it into a reality, and making it such a positive experience. As you can tell from today alone, we've had just excellent presenters along the way, some really marvelous sort of value added from the people that we've asked to join us on these online webinars. So very indebted to them as well. We're going to be doing with Cher, we're going to be doing an evaluation of how this series went, I think we're almost certain to repeat the process. It would be very surprising to me if we decided not to do it again. But we're going to have to consult with people who were part of the process on whether or not we repeat. For example, do we go back to the same notion and run again a series for the basics of pensions, or do we build on that and run the next series on a more advanced level for people who've already gone through the basics, or maybe do we do all of the above, or we keep on running the basics on a regular basis but build on it as well? So that's work that we're going to be looking at, and when you get your evaluations, we hope that you will guide us on those decisions. I remember saying at the first of these series that for a number of years now, far too many years, pensions have been under attack in Canada. I imagine most people who are listening to this will know that. Within the National Union family, we certainly have shared in those attacks. We've had a number of them across the provinces. But we've also been fighting back, of course, and we've won many significant battles along the way. And along the way, what we've done is not only win the battles to defend our plans, but we've also made some major advances as we've moved along the path. And one of those major advances is that we've expanded joint trusteeship. And I want to go back to the basic sort of notion that we had when we first began this fight for joint trusteeship a couple of decades ago now. And the idea was it's our members' money. And we shouldn't be collecting our members' money and then turning it over to somebody else to decide what to do with it. That we should, as representatives of our members, be major players in what happens to that money after it's gathered and while it's waiting to be turned into a pension for our membership. So we've got joint trusteeship in the majority of provinces now, and joint trusteeship has proven to be the most effective way for a public sector pension plan to operate. There's just no question about that anymore. But joint trusteeship then leads to another interesting set of questions, and that's what today has been all about. It means that we've got some say over a huge pool of capital. Within the National Union family alone, the last figure that I saw, we would be in excess of 160 billion in pension funds within the National Union family. In fact, I think that figure is dated. It's probably, excuse me again, it's probably quite a bit more than that by now. So job number one, of course, as Mike said, job number one is to manage that money, those funds, so as to ensure reliable and decent pensions. That's pretty straightforward. But increasingly, we've looked at that and said, is that all there is? As that song used to say, is that all there is to this? And of course, it isn't. We heard from Kevin the theory of why it was necessary to be involved in really making decisions about investment that are more than just about maximizing investment returns, but also looking at the quality of the investment and whether or not it was going to damage our members' interest. And we heard from Mike a very convincing presentation of how that works in practice. So we want to continue that kind of work for sure, because if we look at it, it doesn't make sense to us to say that our members' money would be invested in a company that wants to privatize public services. That doesn't make any sense. We don't think it makes sense to have our money invest in privatizing infrastructure, where a road would be turned from a public utility into a private for-profit thing that only people who could afford to drive on it can use. We want to expand it beyond that, though. We don't think it makes a lot of sense for our members' money to be invested in companies that then turn around and join things like the Canadian Federation of Independent Business in attacking public sector pension plans. We wonder why our money would go into a corporation that turns around and politically supports political parties that we don't agree with. We wonder about why we would be investing in companies who then go and lobby governments for things like trade deals that are going to hurt us over the long run. The point of all that is that we've done some really wonderful work on using joint trusteeship to make a difference, but we haven't done enough. We could say in some ways that if there was a scale of 10 that we could reach with respect to joint trusteeship, that we may be at 1 or 2 along that road to the really full implementation of what joint trusteeship could mean for our members in the sense of changing the way our economy works. We're dealing in an economy where growing income inequality has been a feature for 2 decades, where there's immense power within corporate leadership, where the corner suites in corporations are paid exorbitant amounts of money, and that takes away from the return on our investment because it goes into the pockets of the CEO. There's a number of ways that we could be doing more than we have to really say that this economic system is not one that we want to prop up with our pension funds, but one that we want to change with our pension funds, where we use that economic power in a more considered and effective way. And I mentioned that we have a whole bunch of money in the National Union family and in joint trusteeship. Around the world, the amount of money is staggering. It's in the trillions of dollars that is in union pension funds, union managed or union jointly trusteed pension funds. That's an immense amount of potential power. And what we haven't done well enough yet is to coordinate our efforts, so that if BCGEU, one of our components, is pulling in one direction and OPSU is pulling in another, or if they're doing something where OPSU is doing one really good activity, but BCGEU doesn't know about it and is doing another, we're not maximizing our potential power. And that goes to working then with other unions. We should be working with CUPE to say, can we maximize the effect that we're having by using our joint trusteeship? And then Mike said, he and I just came back from Amsterdam, where we were talking with unions around the world about how to maximize the power of trillions of dollars by increasing our coordination and increasing our ability to work together to make sure that we maximize our power in a situation where economic power matters greatly, and economic power is being used really in a way to make our political and economic systems less than they used to be, and we want to build it into more instead of less. So this area isn't easy. It hasn't been easy. It hasn't been easy for OPSU, who's been doing it for the longest of any of our components. It isn't easy now for those components, Nova Scotia and Newfoundland, who are just coming on stream. But nothing really worth doing has ever been really easy, and that shouldn't stop us. And in this area, I guess I want to sort of close off this set of webinars by saying that in this area of the potential for using our strength, our economic strength, to match our trade union strength, we should be careful to dream no small dreams. We should continue to work towards positive and progressive use of our economic power, married to the power of our membership, to make a positive difference in Canada and the world. So those of you who are on this session, I hope you've enjoyed this one. I hope you've enjoyed all of them. I hope you've learned from the webinars. And we all at the National Union and the various presenters, we all look forward to working with you in the future as we continue to move towards our bigger goals. Thanks very much.
Thank you, Larry, for those comments. I'll now take questions from some of our attendees. Once again, I'd like to remind you that to submit a question, you can type it into the questions box on your GoToWebinar control panel. Our first question that we do have, and maybe I'll address it to Kevin first, and then if Mike and Larry want to chime in. The first question we have is, where can plan trustees go to access policy language or support to help create a framework on social and environmental investing?
Thanks. That's a good question. Well, I'm happy to say Share has a new website which is just launched last week, so much prettier and probably better to navigate than before. We have something called the Responsible Investing Toolkit, which provides a lot of the basics of policy options and ways to set this stuff up, and some ideas on how to advance on this for people who are just getting into it. So it's just going to share.ca and typing in the search box RI Toolkit and see what comes up.
We have our statement of responsible investing principles right on our website at OPSU Pension Trust. So people who want to get those principles, you can just go to our website and bring them up. I suspect a number of our plans in Ontario, probably the College of Applied Arts, and technology, their website, the CAT pension plan probably has it, and at least those two. The HOOP might have theirs on too, the Healthcare of Ontario Pension Plan. So there's a number of places, and OPSU has a lot of this stuff on their direct website as well.
Yeah, I was just going to add, Mike, to your comment that imagine that every member of the National Union, every component of the National Union has people on staff or within their organization that can help to guide people through the search. Because the National Union has some, the SHARE has some, each of our components has some, OPSU has some very, very good information, BCGU does as well, and some of, in other words, there's a lot out there, and maybe one of the things that you could think about is asking your home union to help guide you through and find the best stuff that's available.
The next question we have is, what advice would you give a trustee facing calls for fossil fuel divestment? Again, I'll start first with Kevin, then Mike, then Larry.
Well, that is something which we're seeing quite a bit of, and I think there's a number of approaches to it. One which I'd recommend is taking a look at the University of Toronto President's report on this, because they were obviously faced with this question and tried to grapple with what it meant to either divest or choose other sources of action. And one of the things they came back with was a fairly broad palette of actions that can be taken, including some divestment, but also including active ownership and sort of engagement and proxy voting and policy options to try to take the whole thing into account. When we look at the question of climate change, we try to look a bit broader than just divestment from fossil fuels, because the problem is much bigger than just the fossil fuel companies. It's also making sure we tackle the question of demand, that is companies which are very high energy users, making sure we approach the question Larry spoke to about political lobbying around climate change. So we're addressing the companies that are, and trade associations that are actively lobbying for or against good climate regulations. So all that to say, the divestment on its own may not be the whole answer, and I don't think it is. That while it may be part of the things you choose to do in particular cases, it's not sufficient if you're really serious about this. So it's just going there, and of course, again, there's probably materials on our own site which speak to the steps which trustees can take to address climate change in their portfolios.
We went through early debates around whether or not we should just boycott those kinds of industries, or whether or not we should do engagement. And Kevin talked about that in his presentation. And at the end of the day, although we did determine that, for example, we weren't going to do any investments in armaments or tobacco, with regards to fossil fuel, we took the approach of engagement. And I'm sure that most of you know that in many ways, some of the fossil fuel corporations have now been pushed into bringing new methods of reducing their footprint. But that's not really the answer. There's also we've made targeted investments in green energy. So we've done it on both standpoints, kind of forcing fossil fuels to clean up as much as they can, and maybe at some point in time we'll have to divest completely. On the other hand, making target investments in green energy. But as Kevin said, that's not the end-all and be-all, and it's not the only answer. But it's a question that I think trustees should continually go back to and say, does this make sense? Doesn't this make sense? Should we make other decisions?
I just want to quickly add one other thing to think about as a trustee, and that is there's a number of people who've argued very strongly that the value of fossil fuels is going to start to drop very quickly. That we're, instead of looking at peak oil, we may be looking at peak oil demand, for example, and that all of the money that's tied up in fossil fuel production may end up being a bad investment. So on top of what the other two speakers said, I think people should have a look at whether or not they want to have a lot of money tied up in what is getting to be a very problematic area.
Once again, I'd like to thank Kevin, Mike, and Larry, and all of our participants for being here today. If you have any questions or comments about today's webinar, please feel free to email info@share.ca. If you have attended or watched online all 5 sessions of this webinar series and would like to receive your certificate of completion, please email info@share.ca to request a self-assessment questionnaire. This questionnaire will be available next week. Once the questionnaire has been filled out and returned, you will receive your certificate of completion. Thank you once again for joining us today, and have a great weekend.